Good Wednesday morning, Market Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with the main man, Dimitri Kargamanik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer? It's up there for everyone to take a gander at.
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
All righty.
And let me share my screen. If you guys have any questions, two ways that you could ask those questions. One is to put your question into the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on a show and ask your question live, we also put out a link to Zoom. If you click on that link, it takes you over to Zoom. Once you get to Zoom, click on a button, raise your hand. You don't have to turn on your video camera, but then you could ask your question direct. Everybody will be able to hear you. While we're waiting for questions to come in, what I think I'll do, Will, is we'll take a look at the pre-market report. And I did get a question how to set up a payout diagram for a calendar spread. So I'm gonna do that today.
Perfect.
All right. So we'll start on that. If questions come in, let me know. We'll stop and try to answer those questions. So let's start out with the pre-market report. These are stocks trading in the pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. I see 24 stocks made our percentage gainers list, 41 on the decliners. So from that perspective, looks like slightly bearish bias at the open. We're going to take this list and filter it out to just S&P 500 stocks. So we're taking out low cap stocks, ETFs, leverage products, closed-end funds, preferreds, all that. We're going to remove it just to focus on S&P 500 companies. To do that, I'm going to use this filter in ETF, drop it down, and by selecting one of these ETFs, the list will get filtered by the holdings in that ETF. So SPY, that's the S&P 500 ETF, and I see actually none of them made our percentage gainers list or decliners, which is saying that they're basically trading in an expected range in the pre-market. Okay, so this does have certain thresholds based on volume and move compared to how it usually trades, and it looks like today nothing made that list. Let me just see if that's, unless that's a bug. I got to check that out because that doesn't seem right. All right, so I do have to check that because that might be a bug in there. So I'll check on that, because we did do a publish yesterday, and I know it had to do with an upgrade to our VWAP calculation, so I will check on that. But I think it does look like what we're setting up for a little bit of a bearish bias, Will, at the open.
Yeah, no, they've taken a lot out of the NASDAQ last.
Right. And
actually,
I've been reading, huh?
Well, I was just going to say, Bitcoin's back to near its low. Yeah. And Ethereum, and I think that Ethereum, what's it called? The merge or the split? I forget what they're referring to that as, but that's happening in the next week or so, right?
Right. So that's I think supposedly, they keep pushing it back, but I think that with the Ethereum, they're expecting to merge sometime in September. I think the big news today, Apple, I think, is unveiling their new iPhones. So that's going to be an event today. I believe it's today, right? September 7th. So I think that's on deck for today. Let me just make sure. Yep. September 7th. The other thing I've been reading about, and something new I haven't heard before, but they did a Gallup poll, and according to that poll, they think up to 50% of employees are quiet quitters. Have you ever heard that term, quiet quitters?
The terms all over the place. Yes, I have heard.
Something new where, I had to actually read about it and try to understand it. But I think the basic concept is that right now, a lot of employees just lack motivation at work, right? So basically, you show up to work, you do your bare minimum to get a paycheck, but really you're not motivated to produce, and you're doing the bare minimum to stay on a job as long as they keep you on there. Is that the basic concept?
That's 100% the basic concept. And I mean, listen, when you've been around long enough, you see people. I just spoke to someone the other day. He had worked for Verizon for like 40 years, and he was 2 years away from his full retirement, and they chopped him off at the knees. And so younger employees see this type of stuff, right, within corporate structures, and they could become quiet quitters, right? They realize you could put in a ton of effort, get these rewards, and then at the end of the day, the company, so it's a two-way street, right? And I think it's amazing that it's out there and such, and a lot of it has to do with social media. I mean, people started to post videos on TikTok and about their lifestyle as quiet quitters, and I do think the work from home has allowed it to become way more prevalent, right? There were probably always quiet critters in offices that would hide behind their cubicle and leave right at 5 o'clock. But now it's a whole it's a lifestyle.
It makes the quiet quitter. It makes it easier if you're working from home. I was, as over the summer, I was down the beach, but really, mostly we have to work, right? Because this is, we have no choice. We have to work. But sometimes I make it out to the beach and I see people out there just every day. And I was asking, like, well, how are you, don't you work? I mean, what's going on? Young people, young people, middle-aged people, and, people working like for Google, and they're not motivated. I would say, well, don't you, you're making a really good salary there at Google. You get all these benefits. Don't you want to move up? And the response was like, well, why should I? It's not my company. Why am I going to work hard to make them more money? That's the mentality right now. And some people are in IT, and I was asking, you seem to be doing really well this year, but you're always on the beach, just like, tanning, and they're like, yeah, I have like 2 or 3 jobs, and I could do my job in an hour, but staying at home, you could, bill for whatever. And my wife was asking, well, what, but don't they can't they monitor that you're on there? And like, oh yeah, I just go on Amazon, buy this little mouse, and the mouse makes it look like I'm moving around. So people are just figuring out, but this hurts productivity, right? This is part of the problem right now, that it's entrenched in our economy. And this is what the Fed is now dealing with, where when we have low productivity and full employment, this is inflationary, right? And the Fed is trying to deal with that. That's why our labor market is giving that opportunity out there. So, and I think it's not just, some people look at, well, gas prices might be down, or commodity prices might be down and they fluctuate, but it's our productivity that's really right now suffering. And that is something the Fed, I think, is paying attention to. Let's move on to the question payout diagram. If you don't have any questions, I'm going to move on to a payout diagram with calendars.
Yeah, move on.
So the question was, how do I set up a calendar spread payout diagram? So let's do that in SPY. I will just use SPY as an example. That's kind of like my default. And a payout, first, what is a calendar spread? And I'm here on SPY options chain. I went out to September 19th expiration. And a calendar spread is you're doing two legs, right? Two option legs. One you're buying, one you're selling, but you're doing it in different expirations, right? So same strike, different expirations. And I'm going to set one up right now. And let's just say in September expiration, September 19th expiration, I'll just find, close strike to at the money. So let's use the 391 strike. And let's say I sell this option, right? The 391 call, September 19th expiration, and I buy an option out in a further out expiration on the same strike. So let's just go out to, let's go out to the next one, October 21st. So now I'm on October 21st expiration, and I'm going to use the same strike, 391, buying at 1272. So you could see down here, when I clicked on the call ask, it created a buy, generated like a buy transaction here, right? That's the buy leg, October 21st call, 391 strike, price 1272 because that was the offer, right? So it just auto-populated the offer and operated the buy side. On the September, which one was I on? September 19th. I did the opposite when I was on September 19th. I looked at the 391 call. I clicked on the bid. By doing that, it auto-populates a sell September 19th call 391 strike at $6.46 because that was the bid at the time. So you could go in here and change these if you wanted to, but it auto-populates that just by you clicking on it. So it just makes it easier, right? Instead of you typing it up in a calculator, right? You want to change the prices, you can also change that. If you go into here, you could change the prices, but let's keep it at the original. So let's assume, that these are the prices. Then I'm going to load the strategy to try to generate a payout diagram. So before we go here and explain this payout diagram, there's something first to understand about calendar spreads. So the default payout diagram goes to expiration, right? So you could go back and pick days before expiration, but the default is trying to generate a payout diagram at expiration, because at expiration, the option that expires is going to be either worthless because it's out of the money, or it's going to be in the money, and then the value of that option will be based on how much it's in the money. So with a call, if a call is in the money, the stock is above that call price, and it'll be the difference between the strike price and where the stock is. But in a calendar spread, you cannot really, that calculation doesn't work because these calls, these contracts expire on different expirations, right? So September 19th, we could calculate easily what this call will be worth along different stock prices, right? Because it's not going to have any more time premium. If it's below 300, if the stock price is below 391, that call will be worth 0 at expiration. If it's above 391, that call will be worth the difference between the stock price and the strike price. So on September 19th, that we could calculate, pretty easily because there's no more, time premium in it. But that doesn't mean the same thing for the October 21st call, because that will still have time premium. So September 19th this option goes away, right? But October 21st, well, that option will continue to exist for another, month, right? And it's not obvious what that option will be worth on September 19th, because we don't know, what the implied volatility of that option will be. So and without knowing the implied volatility, we don't know what that, we don't know along the different strike prices what this option will be worth. Okay, so that forces us to make an assumption. Then we have to assume an implied volatility so we could generate an estimated payout diagram. All right, so hopefully everybody is following what I'm saying, but in this situation, a payout diagram at expiration is not gonna, it's gonna need an assumption, because this second leg will not expire September 19th. Okay, why do we use September 19th? Because that's the first expiration. After that, this option will not exist anymore. So this strategy will not exist. September 20th, you don't no longer have a time spread, right? So that's when this, as a strategy, as a time spread, that's the end of it. After that, this will either become worthless, then all you have is just a call, or this will be in the money. And then what will happen is if you get assigned on it, you'll have short stop, right? So you'll have a different position than prior to expiration. So that's when this as a strategy will end. So on September 19th, along the curve, this 391 strike will be easy to plot. October 21st, the default right now is we need to assign it an implied volatility. So the default implied vol is what it is right now. Just assumes the same implied volatility as it is today. But if I change it, right, if I change it and assume, let's say I assume it's going to be 22, I'm going to enter in a new implied vol, like you saw right here, October. Then I could reload that strategy, and then it will plot me a new payout diagram, right? So here you could see we're long Vega. This strategy here is buying an outer month option, selling a near month. So the further out you go, the more Vega that option has, because it has more time premium. So if I raise this, if I assume, hey, on September 19th, implied volatility will go up to 30, right? So right now you could see that our sweet spot is right at the strike, 391. So with implied vol at 22, we see that the payout diagram estimates this strategy will profit $467, right? What if implied volatility goes to 30 on September 19th? 30 on October, rerun it. So you see how this curve then went up. Now you could rerun it, and your at your sweet spot, $391, this payout diagram estimates an $849 return. So those are kind of the things that now you need to make certain assumptions about this option for September 19th. Is that clear to everybody?
That's super helpful.
Hopefully, right. Here, a couple things here. This right here is the market. So for this strategy, $6.13 bid, $6.26 offered, midpoint 620. That helps you see if I try to get an immediate execution from the midpoint, I'm paying up 6 cents. So something to keep in mind. You want to get a good initial execution, because the more you pay, the more risk. And the more you pay, the less potential return. The less you could buy for, the less risk, and the more potential return, right? Another thing to keep in mind, and these are your other initial risk sensitivities to the original trade. So it has, it's basically delta neutral, right? Close to zero. It has slightly short gamma, long vega, your long theta. So you're as the days go by, there's a theta, so you're earning theta, right? It's decaying, and your long rho. All right. So these are kind of your just initial risks, sensitivities to the initial trade. Another way we could try to estimate it is going here to our IBKR, and what this will do is look at historical implied volatilities, okay, and give us a different payout diagram. So this payout diagram assumes that on September 19th, that option, let's say, has 30 days to go, right? And so what it will assume is what will option 2 implied vol be, and what it does is default it to the 50th percentile rank. So what it will do is say option 1, you could see will go to 0, right? So at expiration September 19th, this option ceases to exist. It'll be parity. But option 2, what do we think the implied vols will be? Well, you could see historically with an option at that point, let's say it has 30 days to go. Historically, with 30 days to go, the average implied vol is 18.2, but you could see it had a big range as low as 8, size 76.8, and the 50th percentile rank is 16.8, meaning that if we took all the observations and we looked right in the middle, it was 16.8, not the average, but in the middle. So half observations were higher, half observations were lower. And we could change those assumptions, and let's just say we think that the implied volatility percentile rank will be 70. I'm going to reload it, and now here's a new payout diagram based on the assumptions that September 19th call will go to parity, but the October, what is October 19th? October 21st call at that point will trade at implied volatility in the 70th percentile rank, meaning, we think implied vols will be higher, so it'll be in the 70th percentile. And at that point, we could see this is the payout diagram along different strike prices, right? So that's an example of generating a payout diagram for a calendar spread, and that would be at the first expiration. Now, if you wanted to see it prior to that, you could pick a date. Let's say you're interested to hold it to September 12th. So I'm going to pick September 12th, reload that strategy, and that's this blue line over here, right? So then this blue line over here is saying from today to September 12th, this is the payout diagram based on implied volatility is going to 70th percentile. If we put them to 50th percentile, then this is what it looks like. Okay, on September 12th. So those are a couple different ways to look at a calendar spread and try to generate I guess some people call it an options profit calculator or payout diagram. You only got a couple minutes left, Will.
Lawrence had a quick question. Doesn't it make more sense to use the calendar spreads on the put side to profit from positive vega if stocks declines?
Wait, can you say that again?
The question is, doesn't it make more sense to use calendar spreads on the put side to profit from positive vega if the stock declines?
So not necessarily the put side. I don't think that will matter, but on lower strikes. So puts on a lower strike. So yes, if you think that the stock price will decline, set a target price, right? And obviously you need the set a time horizon. But let's just do that. September 19th, if we think that the stock is going to decline, Vega is going to go up. Let's pick 370 strike. So we sell the 370 strike, right, on September 19th. And then we go to October 21st. And so remember what I did, I clicked on the bid. So right here, now I have this action, sell September 19th expiration put 370 strike for $1.75. And now I'm going to go to the 370 here. And to generate a buy, I'm going to go and click on the offer of this 370 put, $6.52. So there it is. It popped up. October 21st, put 370 for $6.52, like here. Now let's look at it. And here's what this looks like. So it has a bias. You have a negative delta. So you want it to go down. And yes, because you're long Vega, the assumption is as the stock goes down, implied volatilities will increase. So let's just increase that implied vol. And let's say it goes to your sweet spot, right? So let's say it goes from 666. If implied volatility goes up to 35, let's reload it. You see where then you jump up to profit potential of over 1,000, right? So that's that assumption. All right. So in general, yeah, if you're looking for the stock to go lower and implied volatilities to increase, you would want to pick downside strikes, right? So let's just take a look. Here, I'm going to do the same thing, 370 call. So I'm buying the 370 call. Selling the 370. Did I do that correct? So you could see same thing, downside strike, right? So you're picking, it's the strikes that you're picking your sweet spot, and by buying a further out option, so in the nearer term, you're banking on that implied volatility, or you're hoping, your best outcome is that the implied volatility moves higher, at that expiration, at that first expiration. So hopefully we're up at 9:30.
Hopefully that was a great rundown on calendar spreads, Steve. Thanks. That was awesome.
Okay. So thanks everyone for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
All right. Great job as always, Steve. We'll talk to you later. Have a great